Hello and welcome back to FT Markets. The debate over market structure has reignited in recent weeks in the light of Michael Lewis's latest book, Flash Boys. With me to talk about it is Richard Balarkas, Managing Director of Quendon Consulting and an independent market expert. Richard, welcome. Let's try and pull apart some of the main issues here. First of all, is this really anything new?
If you look at the history of stock markets and regulation, I can trace this back to the late 18th century. Your colleagues at the FT probably know much better than I, a fellow called David Ricardo. Extremely famous economist, probably one of the wealthiest economists who ever lived, however, because in his younger days he was a stock jobber, and at the time he made outrageous sums of money. It was claimed something like £120 a day on the London Stock Exchange. And he seemed to do this by not caring too much about the fundamentals of the stocks that he was buying or selling, but purely on the basis that the rest of the market bought and sold too much. Momentum drove prices up or down far too far. He traded on the turn, he traded far too quickly. And there was a huge rumpus at the time, a great deal of suspicion about whether he'd rigged the market and how he was able to make these kinds of profits. So to be honest, this whole question of overactivity, shall we call it speculation versus investment, has been a theme that's vexed regulators throughout history.
Well, interesting you bring that up, because one of the reasons for electronification of the market is people have said that it does actually increase liquidity. If we bring up our first chart here, I think you'll see global electronic trading volumes in the last decade. Do you want to just explain this chart? Is it as simple as it shows?
No, there's actually a beginning and an end to this chart. This is probably in the middle. Now, the beginning of this chart is that technology, which has been having a major impact on equity markets since the 19th century and the introduction of the telegraph. Technology seems to demonstrate that exchanges are natural monopolies. If a telegraph line went from the New York Stock Exchange to Smallville, USA, the local stock exchange in Smallville closed down, trading migrated to the New York Stock Exchange. But over the years, the exchanges themselves were very slow to adapt new technology, and that's because it would threaten the profits of their member firms at the time. So prior to this chart, exchanges were typically members' organizations, self-regulated, and within those organizations only certain people could make spreads, and spreads were very wide apart.
Well, that brings us, interestingly, to the next chart. If we take a look at this, again, another justification for what high-frequency trading has done in the last decade. Spreads have narrowed here, haven't they?
Spreads did narrow. Again, is that the measure of market quality? Not everyone would agree to it being a measure of market quality, and we can see here how, in actual fact, they may have been on the decline until the crisis, volatility erupted, spreads widened again. And on your last chart as well, the end of that last chart on volumes is that volumes have fallen away significantly. And so in the 33 years prior to the financial crisis, US market volumes only decreased in 3 years. Now, since the financial crisis, they've fallen from a peak of 12 billion shares to something like 3 billion last September. Admittedly, there's been a boost both in Europe and the US recently. But the democratization of the markets, forced by politicians, forced through the lever of competition, which has allowed new entrants to actually become price makers in the market, to take advantage of technology, tighter prices, is what has driven the narrowing of spreads and the increase in volume.
Now, clearly, regulators are now under pressure to step into this market. And the question really is, what can they do? Let's bring up the third chart here that shows dark trading in European indices. The European Union has been one of the more aggressive people around, talking about caps in dark pools. Maybe you could explain what this would actually mean.
Well, I'd love to be able to explain it. There's probably not many people who can. What this means is that the European regulators have decided they are going to cap dark pool trading at 4% on one venue. In other words, if it exceeds 4% on only one venue, then dark pool trading will cease for 6 months. If it exceeds 8% across all venues, again, it will cease trading for 6 months. So if we look at the index that is most impacted by these limits, it's actually the FTSE 250. The top 15 stocks affected in Europe are FTSE 250 or FTSE small cap stocks. The underlying key message, though, is that these limits were set on an entirely arbitrary basis by European regulators, who had no idea what the impact would be. In fact, this has all been figured out since the rules came out. Whether or not it leads to improved market efficiency, who knows? But the vast majority of institutional fund managers do not agree with this approach.
Because clearly, as you can see, we've got not just the FTSE 250, FTSE 100, CAC 40, a whole host here who are actually right up against this 8%.
There's a whole swathe of stocks that are affected, but I think the most disappointing thing here is that, out of the three forces that are affecting the industry, technology, politics and regulation. Regulation is probably the most nascent of the three. And as Professor Kay pointed out in his report on the UK equity markets 18 months ago, regulators don't actually have a common view of what the markets are for. They're very happy to bandy about terms like market efficiency, liquidity, market quality, fairness, but neither here nor in the US do they have a blueprint, never mind a consistent blueprint, of what the markets are for and how to measure the efficiency and the fairness of the markets.
Richard, thank you very much. So, in short, it's murky, it's complicated, and it's not easy to simplify.